Welcome back to the channel. A lot to unpack this week. Obviously, headline inflation taken up to 2.9%. Obviously, a lot higher than many economists had predicted. And what is this going to mean for the Bank of Canada as we head into the next rate announcement on July 24th? Is there going to be any other data sets that are going to come out that could sway or move the Bank of Canada to cut rates in July? We'll talk about that, as well as what the governor of the Bank of Canada had to say earlier this week out in Winnipeg about the direction of the Canadian economy, what we can expect or what he's seeing, what they're seeing, as well as what is happening with mortgage renewals and monetary policy. Are we going to hear or see a shift in the coming weeks ahead? We'll unpack that and more on this week's episode. So we welcome you back to the channel. It is Friday, Finance Fridays. I'm your host, Anthony with In Touch Mortgage Solutions. And if you have not subscribed to the channel, we invite you to go ahead and do so. Hit that notification bell, as well as don't forget to leave your thoughts, questions, and comments in the comment section below. And don't forget to give the video a like, thumbs up. Obviously helps the YouTube algorithm get this content out to as many Canadians as possible. And right now in this current environment, especially around the inflation numbers ticking up, a lot of Canadians are wondering what the direction of the Bank of Canada will be. Ultimately, a lot of people predicting a pause, a lot of people saying, hey, maybe they're still going to cut. And ultimately what it is right now that it's too soon to really tell how this new set of data that came out for the month of May can actually move the needle. Why that's important is because, as we know, one data set that moves in one direction obviously isn't going to sway the Bank of Canada, just as, if it was to go the other way, necessarily, bad data doesn't move the Bank of Canada right away, right? This takes time. So ultimately, if we look at what the Bank of Canada is saying, if we dissect that and say, look, the Bank of Canada is looking for a longer term sustained decline in inflation to get to 2%. And ultimately, coming in at 2.9%, headline inflation much higher, CPI, core, medium, and trim, those are the preferred measures of the Bank of Canada, also upticking, but still below 3%. Ultimately, these numbers, they understand, the Bank of Canada understands, the Governing Council understands that there's going to be peaks and valleys and ebbs and flows in these numbers. We're not going to have just a straight, narrow line down to 2%. So it's going to take some time for us to get there, especially when we look at not only here in Canada, but across the the border in the US and what's happening globally. We do understand, the Bank of Canada understands, inflationary pressures are starting to pull back. Now, ultimately, there could be a cataclysmic event that derails this entire conversation. But for the most part, we are expecting inflation to come back down, and the Bank of Canada is pretty confident that that is happening. Now, ultimately, between now and July 24th, which is when the Bank of Canada meets, well, we're going to be getting the CPI headline inflation data for the month of June. So on July 16th, we're going to be getting the inflation numbers for June. We're also at the end of this week, between June 28th and July 5th, we're going to be getting the GDP, gross domestic product numbers from Canada. We're also waiting on additional data for unemployment, so on, and wages. And ultimately, these data sets can help the Bank of Canada formulate where they're going to be when they meet again on July 24th. So ultimately, as we know, the Bank of Canada is very conscientious about the economy, where growth is, and obviously unemployment, obviously where we are. And that is literally echoed in the conversation with the Bank of Canada, the governor earlier this week on Tuesday.
In the 2021 renewal of our monetary policy framework, the federal government and the Bank of Canada agreed price stability is our primary objective. We also agreed monetary policy should continue to support maximum sustainable employment. With higher interest rates, spending has cooled and businesses have scaled back their hiring plans. But it's now getting harder to find a new job. And that's particularly affecting younger workers and newcomers to Canada.
But basically what they're arguing is that we have a significant amount of businesses that are not really, bringing new job postings to the market. We definitely have this relationship where businesses are starting to pull back, okay? That means they're not listing new jobs. We're having that pullback. Is there an impact to the unemployment rate? And what happens as we go from the pandemic era of low interest rates into higher interest rates? How does that impact business sentiment, right? So obviously, if inflation and cost of borrowing is high, that means the cost of capital is more expensive. That means businesses aren't generally looking to take out loans and invest back into their business because it's expensive. and training and educating and creating more productive environments for work tend to be put to the wayside. So speaking of productivity, as we know, back in March, Deputy Governor Carolyn Rogers came out talking about the emergency levels of productivity. And this should come as no surprise to many Canadians. I mean, ultimately, we've fared worse than the US. When we look at this chart, obviously from 2015 till now, there hasn't been much growth. The average Canadian still continues to underperform the US. And ultimately, that has to do a lot with infrastructure. That has a lot to do with investment in businesses and opportunities. So just because there's people working, it doesn't mean that they're productive. Because you work more hours doesn't mean your output is the same.
Now, on the surface, the cause of low productivity growth in Canada is clear enough. On average, businesses in Canada invest much less per worker than they do in the United States. And with less investment in machinery and equipment, particularly information and communication technology, workers in Canada have less and older machines and computers to work with. And weaker investment in intellectual property means they have fewer innovations to help them work smarter, faster, and more efficiently. So it's not surprising they're less productive.
So ultimately what the Bank of Canada governor is pointing to is that we need foreign and Canadian investment in businesses to streamline and make workflows more efficient. For example, if you're manufacturing, what type of assembly lines, robotics, managing those expectations. So just because of the fact that you're manually doing something, it takes longer, you're not as productive as if you were to bring in investment in machinery. Obviously, this conversation comes around productivity, bringing in investment, infrastructure, technology, software, AI, big play right now, obviously, with not only the government allocating funds to artificial intelligence, but the whole play that's happening in the market as well. So obviously, this is where we have to look at the economy, and the Bank of Canada understands that Canada is just not there in comparison to the US. So a lot of times the questions to the Bank of Canada governor are around rate cuts. One is, we're going to see another rate cut. Are we going to see? How many do we expect? And ultimately, the Bank of Canada governor is not going to come out and say, yeah, we're cutting next month, don't you worry. That's not the case. Ultimately, what they're going to do is sort of lay the foundation, lay the groundwork to explain, sort of where they're going, I think, at least in my opinion, so that it doesn't come as a surprise. They're not just going to start letting the markets know we're going to be cutting rates, because ultimately that's not really good either, right? I mean, they don't want to put the carriage in front of the horse, right? That's literally what I really think they're trying to avoid. But the Bank of Canada governor did omit in a conversation that mortgage renewals are a big part of monetary policy decision.
Started raising rates, about 50% of the mortgages have renewed. That means there's about 50% to go. And those renewals actually will have a bigger reset than the ones that have happened already on average. So yes, that does mean that there are more effects to come. And that is something that's factoring into our monetary policy decisions.
The literal way that I look at this is the Bank of Canada is saying, if we see half of Canadians that have already renewed their mortgages and are experiencing payment shocks, and they're already feeling the pressures of these higher payments, and we understand that consumer spending is pulling back as a result of Canadians having to reallocate money to debt than towards the economy or spending in the economy, then we're going to have a major problem moving forward when the other half of Canadians who are renewing their mortgages in 2025 and 2026 reach that renewal cliff. And that, I think, is where that conversation is headed, is because if we're already seeing contraction in growth and the numbers are not up to par with what the Bank of Canada wants, well, they're going to have to make a move. And the Bank of Canada is now maybe understanding that inflation is coming down. It's going to be a slow and steady race to 2%, but obviously there's going to be some bumps in the road.
Price stability is our primary mandate, and a healthy labor market and price stability go hand in hand.
But the economy, if it gets too far gone, if the economy worsens to the point where, hey, we enter this recession, it's a massive recession, unemployment ticks up well above 6.2%, I mean, we've seen it come up, then we have a bigger problem on our hands, right? This is where the economy becomes the silver lining. And if they can't salvage the economy, then they have to decrease those rates, right? They have to drop the hammer on those rates harder and faster to get the economy from sputtering back to firing on all cylinders. So this is really the conversation right now. And I really think July is going to be equally as important as this June announcement. I think that the Bank of Canada is really going to see the writing on the wall. But ultimately, let us know what you think if the Bank of Canada will end up cutting in July on the 24th. You think it's possible? Do you think it's not possible? Let me know in the comment section below what you think. But we'll leave the video here. Wishing everyone a wonderful Friday. Don't forget to subscribe, and we'll see you next week.